Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Tellurian stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 495 million market cap. They're trading at 71 cents a share, and they have 698 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they're not doing so great in free cash flow. It's negative every single year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every single year. The nice thing about revenue is it can never be negative. And their revenue grew a lot from 37 million to 71 million to almost 400 million, but it's come down quite a bit in the trailing 12 months to 229 million. So the growth from 2021 to the trailing 12 months as a percent is really high. But 229 million of revenue is just not that much. In order to get to profitability, they need a lot more revenue than that. Probably north of 1 billion just to get to that break-even point. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 879 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $421 million. We divide that by 698 million shares. And we get a calculated stock price of 60 cents. They're trading at 71 cents, so they're trading at an 18% premium. It's a sell according to the model. This is the 4th video I've done on Tellurian, and the stock is down a ton since that first video, probably well over 90%. So it doesn't seem like the Driftwood project has come to fruition. Maybe in the near future, only time will tell. There are 83 companies in the same industry as Tellurian, and if they have a number in red, they're worse than the median. They spend a little less than the median in CapEx, 457 million. These are investments in property, plant, and equipment. They're spending a lot in CapEx for the Driftwood project. Their debt to equity ratio is better than the average, worse than the median. For every dollar of equity, they have 90 cents of debt. They don't pay a dividend. They have negative free cash flow, so it's a lot worse than median and average. They rank 57th in market cap of the 83 companies. ConocoPhillips is number 1 at 143 billion. Oil and gas E&P, that stands for exploration and production. These are the companies in the upstream part of the oil and production process, the very beginning stages. The companies that find the oil, they pull it from the source, from the ground, or whatever the location is. They do have a really good price to book. It's 0.7. That's the best on this list. So that indicates they're worth more in bankruptcy than as an active company. We can't look at that PE or price to free cash flow. Price to sales is between the median and average. They don't generate much revenue. Their 5-year annual revenue growth rate is really high because they were so tiny in the beginning. There's been some really big changes at this company. It looks like Sharif Suki got the boot, and they appointed Martin Houston as chairman of the board. They named their former general counsel as president. Sharif Suki is a really big name in this industry. He was the founder and CEO of Cheniere Energy. He had a disagreement with Carl Icahn, and he was ousted from that company. And then he started Tellurian. And about 8 years after starting this company with Martin Houston, he's getting ousted from another company. Let's take a look at their most recent 10Q. This is as of 9/30/2023. Let's take a look at their income statement. In the third quarter of 2023, revenue of 43 million, about half of last year, 81 million. And for the trailing 9 months, revenue of 126 million, that's down from 289 million. In 2023, they've had 0 sales in LNG, liquefied natural gas. And natural gas sales are down. So this paints a really poor picture for the company. Of the 43 million of revenue, only 4.2 million is upstream. A majority of their revenue is from marketing and trading. Their marketing and trading division purchases and sells natural gas. This is why the stock fell below $1, because revenue is down, expenses are up. Their operating expenses went from 8 million to 22 million. Development expenses are 10 million, down a little bit. Lots of depreciation, 24 million. G&A, general and administrative expenses, that was almost cut in half from 41 million to 22 million. So higher operating expenses with lower revenue. A big net loss for the third quarter. They did have a net gain in the third quarter of 2022. They spent $4 million of interest on their debt, a $29 million loss from the extinguishment of debt. This means they got rid of some debt, but had to take a loss on it. It could be due to penalties for paying down the debt earlier, or the loss could have been in the change of interest rates. So a net loss of $65 million, that gives them a loss per share of 12 cents. Shares outstanding are up from 538 million to 560 million. Let's look at their balance sheet. 96 million of current assets, 156 million of current liabilities. So they're going to have to add some debt to get through the next 12 months. They do not have enough current assets to cover their current liabilities. They only have 60 million of cash. That's down from 470 million. Receivables are down a lot from 77 million to 24 million. They do have a lot of PP&E, property, plant, and equipment, 1.1 billion. Here's a breakdown of the 1.1 billion. 400 million of upstream assets, 600 million from the Driftwood project, and 85 million of other fixed assets. They have 539 million of liabilities, so their assets minus liabilities is 570 million. The reason their assets are higher than their liabilities is because of all those fixed assets on their balance sheet. They raised 1.7 billion from selling their business. They lost 1.1 billion from running their business. Let's look at the statement of cash flows. This is for the trailing 9 months. So their operating loss wasn't that bad, 2.7 million. Last year they had an operating loss of 66 million. They invested 100 million in acquisitions, another 168 million in the Driftwood project, and it looks like they paid back lots of debt, 166 million. They also issued 48 million of common stock. Here's where the stock has been trading the last 5 years. So back in 2019, it was over $10. And then it came crashing down in the first quarter of 2020. You can see this big drop, falling to about $1. Then it had a really nice run up. It grew to over $5, close to $6 over the next 2 years. And that was in March 2022. But now the stock is trading at its lowest point ever. They're going to need to do a reverse stock split so they don't get delisted. Let's take a look at the company on Simply Wall Street. It's trading at 71 cents, 529 million market cap, down 19% in the past week, down 59% in the past year. Let's see what they say about the company. Tellurian operates in the natural gas business around the world. They are developing a portfolio of natural gas production, LNG marketing, also infrastructure assets that includes 27.6 million tons per annum of LNG export and an associated pipeline. It owns interest in 27,689 acres of natural gas assets and 143 producing wells located in the Haynesville Shale trend of northern Louisiana. They were founded in 2016, headquartered in Houston, Texas. Simply Wall Street doesn't value this company, but 5 analysts have it at $2.64. So they say it's really undervalued. Here's their revenue since 2014. It was $1.5 million. Then it didn't really grow at all for the next few years. In 2018, it got to $5 million. By the end of 2019, $29 million. $37 million for 2020. $71 million for 2021. 2022 is their best year, $390 million. It has come down in the trailing 12 months to $228 million. And the forecast for 2026 is $271 million. Here's their debt since 2015. They did have no debt. They added some in 2020. Then they brought it back down to zero. They added a lot in 2022, $540 million. It is down a little bit to $372 million. Their equity is usually pretty close to their debt. It's a little higher now. $570 million of equity, $372 million of debt. And this green line is their cash. They did have a lot of cash in 2022, $824 million, but they almost ran out of cash, so they're going to need to raise some pretty soon. Their CEO's salary is $1 million, total compensation $4.3 million. His tenure as CEO is 3.2 years. There's been some insider buying in the past 12 months, But since they're getting rid of Sharif Suki, he's been selling off his stock. As you can see, he's been selling lots the past year. So about 25 million shares have been sold in the past 12 months. 56% of the companies held by the general public, 37% by institutions, 4% by insiders, and 3% by private companies. Their biggest shareholder is Vanguard at 6.77%, then BlackRock. UBS owns 0.5%. The Australian company Macquarie, 0.3%. And Sharif Suki sold off most of his stock. He only has 0.26%. Their employee count went up from 39 to 176, down to 102, but it's currently at 171. And the ticker trades in 4 places: the New York Stock Exchange, Deutsche Börse, London Stock Exchange, and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.